Hello and welcome. You're tuned into MF Corner. I'm Sonal Bhutra in the Mumbai studio. Today on the show, we'll discuss or rather explain to our viewers what are the basic mistakes that one should avoid while investing in mutual funds. Mistakes like prioritizing just the historic returns over the quality and future prospects while choosing a fund. Questions like looking at a particular date to start your SIPs and a lot more. To take this forward, we have with us Rahul Jain, President and Head at Nuvama Wealth. Rahul, good afternoon. Thank you so much for joining us. It's been a while since we spoke to each other, so good to have you on the show. And, we are talking at a time when we are seeing a lot of volatility in markets. There are global headwinds as well. So at this time, it's very important to understand what not to do as well. So let's start with the basics. What are some of the most basic mistakes an investor makes while investing in mutual funds?
So hi Sonal, and thank you for inviting me to your show. So I must start by saying that if you look at a mutual fund as a vehicle or instrument or a category, I think it has allowed a lot of Indians to invest into equity markets and finally be part of the Indian growth story. And while I think the momentum around mutual fund is going up, I think there are certain mistakes which when we meet clients, we see it very regularly often, and then we advise not to do the same. I think the first and foremost is that the core philosophy of building wealth or growing your wealth over a long period of time is using asset allocation, where asset allocation means that diversification between three large categories: equity, fixed income or debt, or gold. I think that is the best way of diversifying your portfolio. It's an automatically way of reducing risk on your portfolio. And there's a common saying also that in market which go up, you generally become blind to risk, and the market when falling, you become blind to opportunities. And I think by using asset allocation, you avoid all that, and you can do actually the vice versa of the same. I think that is one thing which every mutual fund investor should follow. So this is one I would say I would think that as an investor or a mutual fund investor you should look at. Second is that we see a lot of mutual fund investors who have large number of schemes. So I've also met a client who has 50 mutual fund schemes invested into. I would say that over diversification or having too much of schemes or mutual fund in your portfolio can be very ineffective because your ability to monitor them becomes very difficult, very challenging, and that is where your portfolio becomes inefficient. Third is, I would say it's not a mistake, but I would say that we always advise that while you invest in mutual funds, you should always have a goal and objective. If you don't have, you still can start, but having an objective will always allow you to plan your cash flows, your what amount of money you should invest if you have a goal objective, and then you can work around that accordingly. And fourth is that it's not a mistake, but what we keep telling is that if you don't understand on your own, I think it always be better to take advice from someone who can help you out in selecting mutual funds, selecting schemes, and also while you select those, I think the other important part is to monitor and regularly review. So these are four things which I say that can be common mistakes or something which people should look out for.
No, absolutely. And these are the most basic things, but it's important to keep them in mind for sure. And the next question is the usual understanding of mutual funds. It is that they track returns of an underlying, be it equity, be it debt, gold, or a mix. You said asset allocation is important. But do you think that much understanding is enough and you don't need to go beyond that?
So I would say that yes, tracking to the underlying is important because while you're investing in something, having a benchmark where you can compare it to is important and critical. It's always good to have a benchmark where you can compare it to. But it's not that in complete sense. I would say that the fund manager, his skills, the practices or the process what the wealth management, the fund management team uses is also very critical and very important while you look out for the mutual fund performance. I would say that the consistency and the quality of the returns is very critical and important. And just tracking to the underlying might not be the only thing.
Okay. So that is about the underlying. But sometimes what happens is when somebody is looking at mutual funds, the first thing that they look at is past returns. What has the fund done in the past? But is that enough to decide whether you should invest in a mutual fund or not?
So again, a very similar thing where when you're investing in a mutual fund, you have to look at future, because whenever you invest, you have to look at future. And you have to look at the fund manager thesis, his strategy, his thinking, his thought process on the same. But yes, I would say looking at past performance is also very important, because there has to be some benchmark, some thought process thinking on looking and how to evaluate something. And in that sense, past performance is an important parameter to look at. So while you look at, I would say you should look at on funds which are consistent and which have quality. So one of the things is that there are a lot of people who go invest in looking at 12-month return. I would say that just not look at 12-month return, look at a 3-year, 5-year horizon as well. Another thing is that you should also look at a mutual fund which has done outperformance over the benchmark or have been the top quarter in a large part of their quarter. So that is where consistency also comes into picture. So while you look at past performance, you should not get biased by just looking at the short-term performance. Having a longer-term performance also into context will be important and critical.
Okay. When we talk about returns, one thing that people don't talk about is risk, because risk profiles could be different for different people. In that case, which risk profile should be kept in mind for different categories, be it the equity category, be it the debt category, gold for that matter? How can one go about doing that investments?
So I think, again, the risk categories are also important, and risk is, I would say, your ability to take risk and your willingness to take risk. To just make it clear, I would say ability is more on the basis of your family background, your current salary, your net worth, etc., which creates that ability for you to take risk. Willingness is something which comes from how you react to risky movements. For example, if market is going down or if your investments are going down, how would you react? So generally, you will find a lot of people who are not very risk averse. They would say that we want to take risk. There are people who don't want to take risk, and their behaviors are very different. So having a risk understanding is important, because that will allow you to have a understanding between asset allocation. So, for example, an aggressive investor might take a more percentage of portfolio into equities, while on the other hand, a conservative will have more fixed income or debt into the portfolio. So that is one thing which you have to look out for. I think when you look at equity allocation also, your risk differs, correct? A small cap versus a large cap has a very different risk levels effectively. So while you look at your asset allocation level, I think then the mapping in the equity allocation also you have to understand your risk. And if you're conservative, then you might go into more large cap. But if you want to invest for a very long term and you have age by your side and you're a high risk taker, then you can go with more mid cap, small cap. So I would say that risk is an important parameter while you're looking on thinking of investing in mutual funds. Which category to pick, how should your asset allocation all is somewhere related or correlate to your risk profile.
And the kind of returns that we've seen in last 3-4 years, it's very important to understand the risks associated with different asset classes as well, for sure. Rahul, we have to take a quick break, so we'll do that. On the other side, we'll continue our conversation with you to understand all about the mistakes that you need to avoid while investing in mutual funds. Stay tuned.
smallest business ventures to multi-million-dollar global corporations. Meet the movers and shakers. Today's newsmakers and tomorrow's leaders. Understand what makes markets move, how companies make quantum leaps, and how giant corporations stay ahead. Get the biggest business stories of the day, power-packed into 30 minutes. On Business 360 at these times.
CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of politics.
Welcome back. You're still tuned into MF Corner. We still have with us Rahul Jain, President and Head at Nuvama Wealth, and we're discussing everything about what you shouldn't do while you're looking at investing in mutual funds. Rahul, you know, a lot of investors, they always have this question whether a particular date is good for SIPs. Is this true? Is there this magic date when if you invest, things will work out for you?
There is no evidence, empirical evidence for telling that there is particular date where you invest, the chance of you getting better rates is available. I would say that SIP rates are there for convenience to the investors or clients so that they can manage their cash flow. And I think that is what it's all about. There is no magical date, Sonal, where you can finally help people to make more money on mutual funds by predicting the date.
If only one could do that, but history just shows us that keep doing your SIP no matter what, be it a down day, be it an up day or anything for that matter. So in that case, Rahul, what is more important, the fund or the AMC? You can have multi-cap funds across AMCs. You can have a fund with, you know, similar holdings also across AMCs, because a lot of times investors look at the AMC rather than the constituents of a fund, maybe the size of the fund. What should their ideal investment strategy be in this case?
So I would again, both are important, where the fund and the AMC both are would be important parameters to check out for. I would say that whenever a investor is looking out for investing in any mutual fund, you should look at both qualitative and quantitative aspects. So whenever you look at qualitative aspects, it will be more towards the fund or the asset management company who's managing it. So there'll be pedigree of the organization, the asset management company, the credibility of the fund manager, his vintage, his performance, past performance, which will come into play. So all these qualitative facts or parameters will allow you to understand more about the fund management team or the company. The quantitative part is more towards the actual that fund, where there is the past performance, which also we spoke earlier. That is an important parameter. The other parameter is the expense ratio for that particular fund. What is the particular strategy for that fund which is getting used? And there are other risk ratios or ratios which can help you tell how that fund is versus the other ones, which can allow you to finally select out a lot of schemes. So I would say that it will always be a combination of the asset AMC and the constituent of fund coming together. It has to be a combination of both. It cannot be independent. And I would say that an investor should not only look at the mutual fund AMC, or he should not only look at the constituent fund. He should look at both coming together.
It is a combination at the end of the day. You know, let's take it a little forward, because when we are talking about mutual funds, suppose you've chosen one. In that case, which would be better for an investor? Dividend plan or growth plan? Because there have been a lot of changes the way things are taxed as well now. So what would you suggest here?
So dividend plan and growth plan depends on the objective of the investor. These both plans are only relevant for the equity part mostly. If your aim is to build wealth over a longer period of time while investing into equity mutual funds, I think then the growth plan works well because there's a compounding which is happening where your money is getting compounding. Also, the extra what you're earning is also getting compounded. And for generating wealth over a long period of time and creating a substantial amount, I think compounding at the play is very, very important, very, very critical to keep in mind. So if someone is looking for wealth creation over a long period of time, I think growth works well. There are a lot of investors who want cash flow also. So for them, a dividend option might be more relevant in that sense. But while you choose this, I think you should also keep in mind the tax implication. So all dividend payouts are taxed at your slab rates, or you can say MMR, while your growth, whenever you do the redemptions, there are taxed in either short-term capital, which is 20%, or long-term, which is 12.5. So rather than taking dividend, you can take redemption also effectively, and you might have a tax saving there as a strategy. So that is something which an individual can look out for. But obviously, since the objective of investors can be different, and then according to their suitability of the objective, they can assign or they can think about investing in a growth or a dividend plan.
Okay, because the general idea was do not invest in dividend funds, you'll have to pay higher taxes. But of course, it also depends on your cash flows. If you need that regular income, maybe you would go ahead and invest in a dividend fund when it comes to equity mutual funds. Say, Rahul, once you do the SIPs, how often is it important to monitor it, reassess the investments you've made?
So SIP is done from long-term perspective, and SIP can allow you to build sustainable wealth or a sizable wealth over a period of time investing in small chunks, I would say, where the compounding happens over a longer period of time. So one thing is that you should continue your SIPs for long-term and think long-term there. Also use the bad markets, falling markets to average out your SIP. I think that's a best way. Now, coming to your point, Sonal, of monitoring or reviewing, I think it depends on investor to investor. But reviewing in a 3-month period or quarterly or half-yearly is a good one. While you review or monitor your portfolio, I think the core is that the weaker or the fundamentally weak mutual funds that were not doing well, etc., should be weeded out, because what we have seen that people keep adding new schemes but are not weeding out the fundamentally weak schemes out of the portfolio. Those fundamentally weak schemes actually create a lot of drag on the portfolio. I would say they reduce the return on your portfolios, and in the end they also reduce your compounding, etc., which can have impact on your long-term money, what you could have created if you would have done this exercise well.
Okay. You know, what is happening now also is, Rahul, that a lot of people are using borrowed money to invest in mutual funds in order to beat their interest rates, because the returns in markets have been really high. Is it advisable at all? What's the general sense that you're getting when it comes to trends right now, when it comes to the younger generation investing?
So we don't advise leveraging for investment in equity mutual funds, because end of the day, when I was earlier speaking about asset allocation, it is a combination of equity, debt, and gold. Now, once you do a leverage for investing in mutual funds, I think your equity allocation goes up significantly higher, because now you have leveraged as well. And I would say that markets are supposed to be played for long term rather than having a very short term thought process thinking here. And no one can predict market very well to the T that whether it will go down or go up. So it can be risky in that sense, and generally invest the amount what you save, out of that only you invest on equity market. That is what we keep advising our clients as well. And generally advise clients not to leverage for investing in mutual funds.
Makes sense, and that is a caution that we like to talk to the viewers every time we talk about investing in the show as well. Rahul, always a pleasure speaking with you. Thank you so much for joining us today and giving us your take on what are the mistakes or what are some of the don'ts that investors should keep in mind when they're investing in mutual funds.
Same here, Sonal, and thanks for inviting me to your show.
Okay. All right, Rahul, look forward to speaking to you very soon again. But, interestingly, in the first answer, Rahul spoke about how one should not be looking at sectoral or thematic funds if they're not, if they don't have the expertise there. So just thought we'll pull up the data that we saw came last week, how sectoral funds have been doing in the last couple of months. There has been a massive inflow, 22,352 crore rupees in the month of June. It has ebbed a bit. July, it is around 18,386 crore rupees. But remember, sectoral funds are still 14% of the equity AUM. So that's still a big number. And it's of course led by the new the NFOs that are coming in, be it the energy fund, be it the automotive fund. A lot of AMCs seeing a lot of interest in these thematic funds. But there's some caution that is coming in from wealth advisors. With that, we'll do one thing. We'll take your leave on this edition of Mutual Fund Corner. You stay tuned for Closing Bell to take you through the last hour of trade.